China's future hangs by a thread. Empty cities, falling births, and a faltering economy. This isn't fiction, it's an impending reality. A plummeting birth rate is pushing China toward a population crisis, threatening its stability. Simultaneously, the economy is in jeopardy. Declining consumer prices and shuttered factories paint a picture of economic distress. And then there are the ghost cities, vast, vacant, and whispering a development disaster. How will China solve these converging crises? Is this the beginning of its downfall? Stay with us as we explore the depth of these challenges and what they mean for China and the world. China, without a doubt, faces a critical situation, with its very future at stake. The country's birth rate is plummeting, leading to a population crisis. This is more than just a statistic. It's a pressing problem that threatens China's stability. The government, recognizing this in January 2023, now grapples with a dilemma: how to encourage more births without hurting the economy. Even efforts to boost birth rates may not be enough to change the overall downward trend. April 2023 marked a crucial moment when it was announced that India is expected to surpass China in population. Now, this isn't just about who holds the title of the most populous nation. It signals a significant shift in global dynamics. China, long thought of as an unstoppable force, is showing signs of vulnerability, particularly in its demographic challenges. This reality should reshape how the West views China's rise, acknowledging both its impact and its limitations. The National Bureau of Statistics revealed a shocking fact. China's population decreased last year, the first decline in 6 decades, and happening much sooner than predicted. The fertility rate has dropped to alarmingly low levels, despite the introduction of a 2-child policy. The number of births in recent years is the lowest since 1790. But there's a twist. These numbers might not be entirely accurate. Past figures were likely overstated, painting a misleading picture of the fertility rate and the number of births. Reports from the United Nations, often seen as reliable, consistently misjudge China's demographic trends. Their estimates have been consistently off, suggesting the population decline started much later than it likely did. They predict a drastic drop to 767 million by 2100, a sharp difference to earlier, more optimistic projections. This discrepancy stresses the uncertainty and seriousness of China's demographic crisis, a situation with far-reaching implications not just for China, but for the entire world. The World Population Prospects, or WPP, continues to overestimate China's population. While their 2022 report states China's population at 1.43 billion, a more realistic estimate might be closer to 1.28 billion. This inconsistency is not new. Historical data shows similar overestimations. For example, the actual birth counts in 1990 and 2000, as per census data, are significantly lower than what WPP reported. The WPP's future projections are also optimistic. They predict a fertility rate that seems unlikely when compared to the consistently low rates in regions like Hong Kong, Macau, Taiwan, and among Chinese Singaporeans, despite attempts to encourage more births. China faces a complex challenge in increasing its fertility rate. The former one-child policy has had long-lasting economic impacts, making child rearing increasingly expensive. For instance, China's household disposable income is much lower than in countries like the US and UK, and the Chinese housing market is disproportionately large compared to its GDP. This creates a difficult situation for young couples who might want more children but can't afford them. The dilemma for Chinese policymakers is stark. If they don't address the high cost of housing, having 2 children remains unaffordable for most. Yet, if they intervene too heavily and the real estate market crashes, it could trigger an economic and global financial crisis. Additionally, increasing household disposable income could undermine the government's control over the economy, which is crucial for its current political strategy. China might consider adopting Japanese-style policies to reduce child-rearing costs, such as lowering school fees and offering childcare and housing subsidies. However, Japan's experience shows this approach can be costly and not always effective. With a temporary increase in fertility rates, Japan still faced a decline, and China might not have the financial resources to replicate such policies effectively, especially as it faces aging before becoming economically affluent. Another reason why China is facing a severe demographic challenge is due to both societal changes and past policies. The rate of infertility has climbed alarmingly, from a mere 2% in the early 1980s to a staggering 18% by 2020. This shift is partly because more women are postponing marriage and childbirth. The impact is evident. Since 2013, the number of first marriages has plummeted by over 50%, and among those aged 20 to 24, it has dropped by a massive 75%. The long-standing one-child policy, which lasted 36 years, has deeply influenced attitudes toward family size. Now, having just one child or none at all has become the accepted norm. This trend is growing stronger with each generation. A recent survey reveals that while the average Chinese woman wants around 1.64 children, this number dips to 1.54 for those born after 1990 and 1.48 for women born after 2000. To put this in perspective, the average desired number of children in South Korea and Hong Kong is 1.92 and 1.41, respectively. These figures are only about half of what is needed to maintain their populations. If this reluctance to have children continues, China's fertility rate might not even reach 0.8, leading to a population decrease to less than 1.02 billion by 2050 and an extreme fall to 310 million by 2100. Historically, China bounced back from population dips caused by war and famine. Today's scenario is different and more complex. Like a body struggling to recover from a severe illness, China's population decline is a hard problem to reverse. Other projections show that China's population could fall below 1 billion by 2080 and further to under 800 million by 2100. These numbers might vary, but the declining trend seems inevitable. Even with efforts to boost the fertility rate to 1.1, China might see its population reduced to 1.02 billion by 2050 and 440 million by 2100. The country, which once constituted 37% of the world's population in 1820, could see its share drop to 11% by 2050 and further to 4% by 2100. The demographic decline in China will worsen its aging problem, holding back economic growth and increasing government debt. By 2050, 35% of the Chinese population will be over 65, a sharp rise from 14% in 2020. The workforce to retiree ratio is set to drop dramatically, from 5 working-age people per senior in 2020 to just 1.6 in 2050. This will likely lead to a severe pension crisis and a humanitarian disaster, extremely affecting women who tend to live longer than men and often have older spouses. Could this be another Italy in the making? What's more worrying is that the aging and shrinking workforce in China will significantly limit its power growth in the coming decades. The working age population, which peaked at over 900 million in 2011, is projected to fall by nearly a quarter to about 700 million by mid-century. This smaller workforce will be responsible for supporting an elderly population that will more than double from 200 million today to nearly 500 million. Compared to the social security challenges in the US, China's situation is far more daunting. In comparison to China, India's population will continue to grow, reaching around 1.7 billion by 2060 before stabilizing at about 1.5 billion by the end of the century. These figures, while approximate, are based on current demographic trends and mirror patterns seen in other modernizing societies. Of course, unforeseen events like major policy shifts or global crises could alter these projections. By the century's end, the U.S. population is expected to exceed 400 million, more than half of China's projected population. While China will remain larger in terms of population, the gap between the two countries will narrow significantly, including NATO and key East Asian allies. The Western Alliance system currently consists of about 1 billion people, roughly 70% of China's total. Despite some allies facing demographic declines, American and Filipino population growth is likely to balance out decreases in Europe, Japan, and Korea. After 2050, the Western Alliance could rival China in total population. Additionally, it's expected to maintain a higher per capita wealth. Economists even suggest that while China might surpass the US in GDP in the coming decades, America could reclaim the title of the world's largest economy by the century's end. However, these demographic trends shouldn't lead to complacency regarding the challenges posed by Beijing. In the short to medium term, China's power and military prospects are limited by American and allied military and technological superiority. In the longer term, demographic shifts and resource scarcity will further constrain China. If Western nations manage their affairs effectively, time may not be as favorable to China as it once seemed. And now, let's jump into the present reality of China's ghost cities. Imagine stepping into a city where the future was once envisioned in gigantic skyscrapers and wide, sprawling streets. But now, all that meets the eye is a spooky emptiness. This is indeed the reality of China's ghost cities, a phenomenon growing more prominent and more unsettling by the day. Across the country, there are possibly as many as 50 of these ghost cities, each a memorial to overreaching ambition and unfulfilled dreams. Let's pause for a moment and visualize these cities. They have all the hallmarks of modern urban landscapes, advanced infrastructure, impressive buildings reaching for the sky, roads designed for busy traffic. Yet, they stand silent, devoid of life. Buildings that should be alive with the daily activities of thousands remain empty, echoing with the ghost of activities that never were. Streets that should be filled with the hum of cars and the chatter of daily life are creepily quiet. These ghost cities are loud symbols of a miscalculation on a grand scale. They represent the dreams of rapid urbanization that have crashed against the hard shores of demographic and economic truths. Before we dig into this intrigue, we ask ourselves, what led to this? How did a nation known for having a strong economy and professional planning find itself haunted by the specters of these empty urban landscapes? And more importantly, what does this tell us about the future of China's economic and urban planning strategies? We may begin this exploration by looking at our first striking example, Ordos. In Inner Mongolia, Ordos is like a scene from a science fiction movie, a city built for a future that never arrived. Photographers have described this city in haunting terms. Back in the early 2000s, fueled by a coal mining surge, China expected a massive population influx into newly built cities like Ordo. They projected 1 million residents, but a decade later, the reality was completely different. Nearby, there's the established Ordos Old Town already thriving. The new ghost town of Ordos didn't appeal to many, it seems. Primarily, migrant workers and government officials resided there, with offices relocated to incentivize settlement. Yet, it wasn't enough. The city surely highlights the making of a miscalculated investment. Up to 90% of the properties are investor-owned, held in the hopes of future profits. By 2016, the government adjusted their expectations for Ordos, aiming for a reduced population of 300,000. Still, high taxes and subpar construction deterred residents. The actual population hung around 100,000, far below even the revised target. Mind you, this isn't just an isolated case. Across China, there are approximately 65 million vacant homes. This is enough to house the entire population of the UK, Tanzania, France, or maybe perhaps provide shelter for a quarter of China's 300 million homeless. The abundance of these homes is largely due to the middle class seeing real estate as a secure investment. But this strategy has led to vast, empty urban landscapes. Once again, these ghost cities truly showcase what economic imbalance and planning gone awry look like. In China, people often invest in multiple properties as they can't invest abroad, making real estate a preferred way to safeguard savings. This has fueled continuous construction, critical for the growth of China's economy. In Ordos, 2 horse statues stand, symbolizing the nomadic heritage of the region. Yet ironically, they represent a desire to be anywhere but these empty streets. Let's move on to another example. Kunming and its ghost neighborhood. Unlike entire ghost cities, Kunming, similar in size to Madrid, has pockets of desolation within it. Sunshine City in Kunming, for instance, saw its most significant event in 2021 when 15 incomplete skyscrapers were demolished. Started in 2011, the construction was abandoned in 2013 due to the developer's financial crisis. Then there's Evergrande Splendor Kunming mega project designed for 60,000 residents. Despite claims of 30,000 inhabitants, its facilities like shops, kindergarten, and hospital remain closed. Evergrande, a major property developer in China, is buried under a $300 billion debt, surpassing Portugal's GDP. The insistent building continued, but the debts mounted just as fast. Tianducheng, known as China's Paris, is another peculiar case. This city wasn't just inspired by Paris, it replicated it. Strolling through Tianducheng, you'll see familiar Parisian landmarks like the Arc de Triomphe, Champs-Élysées, and even the Eiffel Tower. This practice, known as duplicate architecture, involves creating exact replicas of iconic structures. To some, this might seem tasteless, while others see it as a convenient way to experience Paris without leaving China. These ghost cities and neighborhoods reflect a complex interplay of cultural aspirations, economic ambitions, and the unintended consequences of rapid urbanization. The town initially aimed for a population of 10,000. By 2021, it reached only 10% of that goal. Surprisingly, most of these few residents are just tourists from Shanghai, leaving us to ponder why it has turned into a ghost town. Tian Ducheng is so fixated on copying Paris that it's driven the property prices to exorbitant levels, far beyond what most people can afford. And truthfully, the charm and attraction of Paris aren't things you can just replicate with buildings and streets. Now, consider Ujiapu, dubbed China's Manhattan. The city's promotional video sarcastically highlights the absence of problems common in major American cities like homelessness and drug addiction, set against an impressive skyline. Yet, while it's true that Ujiapu doesn't have these issues, it also lacks something crucial: life. The streets are devoid of the hustle and bustle of daily activities. Bloomberg's report from a visit in May 2021 confirms this, describing empty streets and abandoned structures, a scene not much improved since their 2015 visit. Then there's Thames Town, Shanghai's answer to London. Here, the attempts to replicate London have also led to abandonment. Thames Town has elements of classic English culture: red telephone boxes, fish and chip shops, English pubs, but lacks the vibrancy, or, the essence of an actual city. It's far from the lively streets of Piccadilly Circus. The town was meant for students and university workers, but the high living costs have driven them away. The refusal of property owners to reduce prices has turned Thames Town into a ghostly shadow of itself, reminiscent of the depressing, desolate, barren scenes in the film 28 Days Later. Then there's Chiangong, a unique case among these ghost cities. Originally a ghost town, it's now showing signs of recovery. Transformed from natural landscapes in 2003, it initially became a city with no takers. But unlike its counterparts, Chiangong is gradually moving away from its ghost town status, offering a flicker of hope that such cities can revive and thrive. However, Chiangong's status as a ghost city changes during the winter break as it has evolved into a hub for students. Home to 7 colleges, the area is filled with new energy. Although not densely populated like a major city, Chiangong is slowly transforming. The presence of night markets, street vendors, and the weekend social buzz of young people signal this change. Even international retailers like H&M and Zara have established a presence here. And now, leaving behind the haunting images of China's ghost cities, let us hop into a matter of urgent global significance: the alarming instability of China's economy. This issue demands immediate attention, for China's critical role in driving global economic growth now hovers on an unstable edge. Recent unsettling developments have sent shockwaves through international markets, igniting concern among investors and world leaders. The growing skepticism are certainly felt. Can China, once a prime example of economic strength and the world's second largest economy, still counterbalance global economic failings? For the first time in years, the narrative has shifted dramatically. China, traditionally viewed as a strong solution to worldwide economic challenges, now emerges as a central concern. This is a decisive moment, not just for China, but for the entire global economic landscape. The uncertainty surrounding China's economic future raises intense questions. Will it regain its footing as a key player in the global economy? Or are we witnessing the emergence of a critical weak link in the chain of global financial stability? This is indeed a global challenge. The implications of China's economic turbulence extend far beyond its borders, affecting markets, governments, and the livelihoods of people across the globe. From August to September of this year, the Chinese yuan plummeted to its weakest point in 16 years. This significant drop led China's central bank to intervene, setting the yuan's value against the dollar much higher than market predictions. This is a clear sign of the economic challenges China is facing. The country's economic momentum, which saw a brief revival after COVID-19 lockdowns were lifted, is now losing steam. We're seeing falling consumer prices, a worsening real estate crisis, declining exports, and alarming youth unemployment rates so severe that the government has stopped releasing these figures. China's approach to its economic data has long been unclear, with crucial information like actual GDP growth rates kept from global view. This lack of transparency leaves foreign investors guessing about the true state of China's economy. The situation is fueled by recent financial troubles in major real estate and investment firms. Several have defaulted on payments to investors, reigniting fears that the deteriorating housing market could jeopardize financial stability. The government's hesitation to stimulate domestic demand, coupled with contagion fears, has led to a series of lowered growth forecasts. Some major investment banks now predict China's economic growth will fall below 5%. A great example of these troubles is seen in Zhongrong Trust. This firm, handling $87 billion for corporate clients and wealthy individuals, failed to repay about $19 million in investment products to at least 4 companies. These defaults were confirmed in company statements a few months back. The situation has escalated to public protests, with people demanding returns on high-yield investments outside the trust company's offices. The property sector's continued losses threaten to cause broader financial instability. As domestic funds increasingly seek refuge in government bonds and bank deposits, more financial institutions could face serious liquidity issues. Additionally, the growing local government debt in China is a significant worry. This debt has surged largely due to plummeting land sale revenues during the property downturn and the financial strain of enforcing pandemic lockdowns. This severe fiscal pressure at the local level poses a substantial risk to Chinese banks and weighs down the government's capacity to stimulate growth and enhance public services. Beijing's response has been a series of incremental measures aimed at strengthening the economy. These include interest rate cuts and other initiatives to support the property market and consumer sectors. Yet, major economic stimuli have been conspicuously absent. Analysts and economists suggest this cautious approach is due to China's high debt levels, which prevent the kind of aggressive economic boost seen during the global financial crisis 15 years ago. At that time, China launched a 4 trillion yuan, or $586 billion, fiscal plan focusing on government-led infrastructure projects. While this initiative helped mitigate the crisis's impact, it also led to a massive rise in credit and local government debt, leaving long-lasting economic repercussions. The current economic downturn, which has some cyclical elements, might justify more significant stimulus measures. However, policymakers are cautious. They fear that resorting to their traditional economic strategies might further escalate debt levels, leading to more severe problems down the line. Beijing's officials, including those from the People's Bank of China, the financial regulator, and the securities regulator, have acknowledged the necessity to tackle the challenge of systemic debt risks in local governments. They have pledged cooperation to address this issue, as stated in a central bank announcement. As for consumer prices, they have seen a significant decrease, marking the sharpest fall in 3 years. This decline is a clear sign of the economic recovery's instability. The Consumer Price Index, or CPI, dropped by 0.5% in November compared to the previous year, as reported by the National Statistics Bureau on December 9. This decrease is the largest since November 2020 and exceeds the 0.2% fall anticipated by economists. Additionally, producer prices fell by 3%, more than the expected 2.8%. These numbers indicate that factory prices have been in a state of decline for 14 straight months. China's economic struggles this year can be compared with other global regions where the focus is on controlling inflation. Experts from Bloomberg Economics predict that the threat of deflation could linger into 2024. A key factor is the ongoing housing slump that we spoke of earlier, which dampens demand and prices. The consistent decline in CPI figures could amplify deflation concerns in China. With demand remaining weak, addressing this issue should be a top priority for China to achieve more stable and balanced growth. But for now, the threat of deflation in China is severe. It can trigger a vicious cycle, discouraging consumers from making purchases in anticipation of further price drops and impacting overall consumption. Businesses may also reduce production and investment due to uncertain future demand. Deflation poses challenges for monetary policies aimed at stimulating the economy, as falling prices can decrease corporate earnings and make debt repayment harder for companies. China truly hangs on the edge of an economic cliff. In a landscape shadowed by the looming threat of deflation, the nation's financial guardians strive to project calm. The central bank, attempting to quell fears, insists that these pressures are simply momentary shadows. However, beneath this facade of assurance, a dark reality chews at the foundations of the economy. The People's Bank of China, traditionally a stronghold of stability, now faces an unprecedented challenge. Despite their reassurances, the threat of deflation is not just knocking, it's banging at the door. In a bold, almost frantic response, Beijing has steered off its usual fiscal path. The government is now pushing against the tide, increasing the budget deficit in an unforeseen move and compelling banks to aid local governments in refinancing their towering debts at more manageable rates. This shows us that it's not just policy adjustment, it's an emergency maneuver, a clear signal of the gravity of the situation. The stakes are huge. As the government scrambles to boost domestic demand, the world watches, holding its breath. Can these measures reinvigorate a weakening economy? For now, all we know is that on December 8, China's leaders, with a mix of determination and perhaps a hint of desperation, announced an escalation of these fiscal policies. They emphasize not just the need for progress, but survival. The growth target for 2024 is a beacon of hope in these darkening times. But doubts remain and questions repeat themselves in the halls of power and the streets alike. Will these strategies be enough to steer China away from the brink? Or are we witnessing the early chapters of what could be a dramatic economic downfall like never seen before? This is a critical juncture, not just for China, but for the global economy. The outcome of these efforts could redefine the future of one of the world's largest economic powers. The clock is ticking, the risks are mounting, and the world waits, eyes fixed on the giant. And so, as China's future hangs in a delicate balance, a nation is at the brink of monumental change. Will it overcome its demographic decline and economic challenges, or will it face a future unimagined? Your thoughts and perspectives matter in this global discussion. Share your views in the comments, and let's explore this critical issue together. And remember, to stay updated with all our latest videos, hit the like and subscribe buttons and turn on notifications. Join us in uncovering the fate of entire nations.